The credit spread is a simple option strategy which has a limited risk and a high probability of success. In this video, I will cover everything you need to know about the credit spread strategy. How does it work? What is its risk? What's the best way to do it? Then at the end, I will also show you how to sell credit spreads via interactive brokers. Also, do join my Telegram chat group to discuss stocks and personal finance if you have not done so. What is a credit spread? Let's break this down. The word credit means you will receive a credit or receive a premium or money when you perform the strategy. The word spread means that it's a combination of two strategies, where you first sell an option, then buy an option at a further strike price and at the same expiration. There are two types of credit spreads. The first one is a call credit spread. Some like to call it a bear call spread. They are the same thing. And the second one is a put credit spread, or also known as a bull put spread. Now, if you are new to credit spreads, everything that I just said in the past 15 seconds will sound like I'm speaking the language of gods. So, here's a simple visualization to make this easier to understand. Let's first start with the put credit spread. Here, we have a stock trading at $100. By selling a put at $95 strike, ka-ching, you'll get to collect a premium. Now, as long as the stock stays above the $95 strike price, everyone will live happily ever after. And nothing bad will happen because the option will expire worthless and we'll get to keep all our premiums. But the problem starts when the stock falls below the strike price and goes in the money. If it's a stock that you wanted to buy, great! You are now a proud owner of the stock. But if you didn't want to buy the stock, or if you don't have the money to buy the stock, then you liao. Because you will now have to fork out $9,500 to buy 100 of the stock. So, to avoid this, what you can do is buy a put at a further strike price. This new put will act as a stop loss as it will now limit the amount of losses that you will have. So, that's the put credit spread. As for call credit spread, so we can sell a call at $105 strike price to earn some income. If the stock stays below $105, we'll be fine and we'll get to keep all our premiums. But if the stock goes above the strike price, you are in big trouble because there's a potential to have unlimited loss if the stock suddenly goes to the moon. So if you don't want to lose money until pants drop, a way to fix this is to buy a call at a further strike price to limit the amount of losses that you have. And with this, you now have a call credit spread. Now, let's take a look at a real life example to see how much you can profit or lose with credit spreads. One great way to do this is to use a free website called optionsstrat.com. Let's first start with the put credit spread. Right now, Apple is trading at $170. So what I can do is sell a put at $165. By doing so, I will get to collect a net credit of $272. That will be my max profit. As long as the stock price stays above my strike price, I'll be fine. But if Apple starts going in the money, I will start incurring losses. My max loss is when Apple drops all the way to $0, where I can lose up to $16,228. You can calculate the max loss by taking the strike price of the option multiplied by 100 minus the credit that you receive. So $165 times 100 minus $272 and you will get $16,228. So to avoid losing so much money, what you can do is buy a put. Let's say we bought a put at $160 strike price. And immediately, you can see my max loss has gone from $10,000 over to just $371.50. But because you paid money to buy a put, your net credit or max profit has gone down to just $128.50. Yes, your profit is now smaller, but in return, you get to limit your loss if things don't go your way. Lastly, our break-even price is $163.72. The formula for this is the strike of the short put minus the premium that you have collected. So in this case, it is $165 minus $1.28 and you will get $163.72. Next, let's also take a look at the call credit spread. By selling a call at $175, I'll get a net credit of $412.50. That will also be my max profit. As long as the stock stays below $175, I'll be fine. But if the stock goes above the break-even, I will incur a very huge loss all the way to infinity. So to avoid that, I can buy a call at $180. And with that, my max loss is capped at just $339.50, which is a lot more manageable. My net credit and max profit has also gone down to just $160.50, which is fine. And our break-even is $176.61. which is derived by taking the $175 plus the $1.60 premium that you have collected. If I switch over to the table view, you'll start to see why this strategy is so attractive. First, you'll profit when the stock goes in the opposite direction. Second, you'll profit when the stock stays flat because every day, the extrinsic value of the stock decays until it reaches expiration. And third, you will also profit if the stock goes up by a little. You will only start to lose money when the stock goes past your strike price, and even so, your losses are capped. In comparison, when you are trading stocks, the moment you place your trade, in theory, the stock can move in either direction. So you have a much lower probability of success as compared to doing credit spreads. Now, let's talk about what are the best practices to maximize your profits. 1. You should collect a minimum credit that's equal to about 1/3 of the width of the strikes. So, for example, here we have SPY, which is trading at $520. By selling a call at $533 and buying a call at $534, the width of the spread is $1. So my max profit should be around $33, which is what I've gotten in this case. However, you will notice that my $533 strike price is pretty close to the $520 stock price. So if Apple goes up by just 2.5% in the next 1 month, I'll lose money. They don't show the probability of profit here, but the probability of profit is calculated by taking 100 minus the credit received divided by the width of the spread multiplied by 100. So if you plug in the numbers, you get a probability of profit of 69%. So why not sell the call at a further strike price to increase your probability of profit? For example, if I move the spread all the way to $560 and $565, sure, I will get a much higher 98% probability of profit. That's because we also need to look at the risk to reward ratio. In the earlier example, I'm risking $69 to make $31, or a risk to reward ratio of about 2:1. And in the later example, I'm risking $492 to make $8, which has a terrible risk to reward ratio of around 61:1. So I can be making money 61 times in a row. But all it takes is just one bad trade to wipe out all the gains that I've made in the last 61 trades. Hence the rule 1/3 of width, so that you can earn a better reward for the risk that you are taking. 2. You should try to sell at around 30 to 45 days to expiry. Now, some people prefer selling spreads with shorter days to expiry because they feel that the lesser days means lower chance for the stock to move. But here's what the data says. Tasty Trade back-tested selling SPY put spread with a 15 DTE, 45 DTE, and 75 DTE. And what they found is that the longer your days to expiration, the higher your win rate. Then, they also tested this with the put spread. Overall, the win rate is about the same, whether it's for 15 DTE, 45 DTE, or 75 DTE. But they found that the 45 DTE has the highest average profit per day. Here's another interesting data. When they look at the past expected range based on implied volatility versus the actual volatility, what they found was that the implied volatility was higher than the actual volatility only at 45 days to expiry. Or in simple English, you know that implied volatility affects options prices, right? So what this means is that if you are doing less than 45 days to expiry, you are actually getting paid slightly lower than the implied volatility. But by doing 45 days to expiry, you are getting paid slightly better than the actual volatility. This gives you a small advantage to improve your probability of success. Because remember, the higher your profit, the better. Also, just a small side note, by selling longer dated options, you will reduce the frequency of your trades, which means you will get to incur less commissions. Versus if you keep selling a 1-week credit spreads, you will keep paying commissions every week. Third, close the option at 50% profit. So let's say you sell a 45 days to expiry option, and after the 10 days, the credit spread has dropped to 40% of its value. Instead of waiting another 35 days just to earn the remaining 40% and maybe risk the option premium going back up, it's better to lock in the profit and sell another new one to earn another round of premium. Again, Tasty Trade has back-tested this. Here, they are comparing which will give you a higher win rate and better analyzed return on capital. Is it hold to expiration, or close at 50% profits, or close at 21 days to expiry? What they found was that if you hold your options all the way to expiry, you will have a much lower win rate as compared to closing your options at 50% profits. They also found that by closing at 50%, you will have the best average return on capital. Fourth, the credit spread works best when the implied volatility is high. This means the extrinsic value will go up and you will get to collect more premiums. For this, you can head to a free website called Market Chameleon. And if you look at the blue line here, you can see that the stock's implied volatility is currently high. So these are the 4 best practices to maximize your profits. Collect a minimum credit that's equal to about 1/3 of the width of the strikes. Sell at 30 to 45 days to expiry. Close your options at 50% profit. And aim to sell during high implied volatility periods. Now, obviously, these are not hard rules. You can always change it to suit your needs, yeah? So far, we have only talked about the good stuff, where we are taking profits at 50%, increasing our profits, and so on. But what if the stock goes in the money and we start making a loss? How should we handle the positions then? First, if you are confident that the stock will go back out of the money, maybe because you feel it is overextended, in that case, you can try holding till expiration and wait for the rebound. Because remember, you already have a stop loss. So it doesn't matter how deep in the money it goes, your losses will be capped. Second, if you feel it will stay in the money, you can roll the option out of the money. Rolling an option basically means you close your current credit spread and you take a loss. Then open up another new credit spread at a further strike price and further expiration date to cover your losses and possibly collect a credit. For example, let's say I've sold a put credit spread on Tesla and Tesla has been crashing all week long and now I'm losing about $30. In that case, I can close the spread and take the $30 loss and move to 1 week out. Then lower my strike price by $5. By doing so, I'll get to collect a net credit of $115. That will cover my $30 loss and give me some extra profit. However, this is easier said than done because if the option has gone deep in the money, you won't be able to roll it for profit because there's not much extrinsic value left. In that case, it's better to just close the option, take the loss, and start selling another new option. This is fine because when we follow the 1/3 with strike rule, we already know that we will have a probability of profit of around 67%. So this is just a statistical game where if we do it long enough, we'll be able to cover our losses and eventually make a profit. So then, how do you give yourself an edge to improve your probability of profit? Apart from the best practices that I mentioned earlier, here are a few things that you can do. First, you can try to predict the stock movement. For this, you can go to a website called Options AI, where based on the implied volatility, it will show you a range of where the stock can possibly go over the next few weeks. So you can try to sell a credit spread outside of this range. But of course, it's better if you can guess whether the stock can go up or down. So for this, you can open up Trading View, Indicators, look for the Breakout Probability Expo indicator. This indicator will give you a probability on where the stock will go. Another tool that can help is the RSI indicator, which tells you whether a stock is overbought or oversold. If you want to go further, you can also use the RSI as a momentum indicator and divergence indicator. But I won't go into it because it's a topic by itself. For this, you can check out these videos by Trading Labs on how to use RSI. And lastly, in TradingView, you can search for the supports and resistance levels with breaks indicator. This will tell you where the supports and resistance are so that you get a better idea on where to put your trades. But if you find all this confusing, no worries, because IBKR has something that makes analyzing charts a lot easier. So on the web platform, you can click on Research, Discover, Technical Insight, then look for the stock that you want to analyze. Here, you'll find a quick chart analysis which will tell you where the stock might go in the short term, intermediate term, and long term. Then if you scroll down, you will see different support and resistance for the stock depending on which period you are in. If you tap on them, then tap on the bell icon, you'll be able to add an alert to notify you via email when a stock reaches the prices. Next, if you are selling options on individual stocks, avoid doing them over earnings days, as it can be super volatile and hard to predict where the stock might go. If you open up Options AI, it will show you what happened during the past few earnings. In this case, Tesla has either moved up or down by 10% within a day, which is super scary, yeah? Options AI will also show you when is the next earnings date, so make sure to avoid it. Next, I will show you how to sell a credit spread on interactive brokers. But the step will be rather similar on other platforms, yeah? Let's try this on SPY. To do that, I can click on the options button to open up the options chain. For the expiry date, I can go for the option that's expiring on the 3rd of May, which is about 39 days from today. Should I go for the call credit spread or put credit spread? IBKR shows that SPY is currently bullish for the short term. In that case, I would prefer to sell a put credit spread, as I think the stock may continue to be bullish in the near future. So let's try selling a put at $516, then buy a put at $515, which will give me a max return of $29 and a max loss of $70. This fulfills the 1/3 of the spread width criteria, as $29 max profit is about 1/3 of the $100 width. IPKR shows that the probability of profit is 66%. And if you scroll down, you will see the profit to loss diagram. Once you are ready, click order. For quantity, I will just leave it as 1 since I want to sell 1 spread. For order type, you can use limit order. Then set the limit price to the mid price between the bid and ask price. Then, if it doesn't get filled, you can slowly shift your limit price to the ask price. Once you're ready, you can click preview. Check your order to make sure you have selected the right expiry date and strike price. If everything is alright, just click transmit order. Okay, once your order is filled, you can head over to orders and trades and you will see your order here. Here, I've sold an SPY $516 strike put for $4.91 and bought an SPY $515 strike put for $4.63. So I've collected $28 in premiums and I've also paid $2.13 in commissions. And lastly, here's how to close your option. First, look for the credit spread that you have just sold. To close this option, you can click on the 3 dots on the right, then click close. Then everything is the same here. You can enter in how many spreads you want to close, set the limit price and order type. Click preview, then submit your order and you are done. So that was a quick tutorial on how to sell credit spreads. While it may seem super attractive, make sure not to risk more than what you can lose, yeah? For example, try limiting it to just 5 to 10% of your portfolio. That way, you will not lose everything if it doesn't go your way. And even though the profits may seem small, if you can consistently make profits every round, you'll be able to quickly compound them over time. Anyway, that's all for this video. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.